you get a really cheap location and you're stuck and nobody ever sees you, they're never driving by, there's no brand visibility, it's going to be really difficult to move. And there's a reason why the top 3 biggest DSOs in the world, or at least in the country, are all doing retail locations. And it's because it works.
I am so excited for the episode that we're about to share and record here. But before I do that, I've got to go to our Ask Ken segment. And the question that's come in here is, when a DSO is struggling with insurance reimbursements, what's one financial strategy they can use to ease the cash crunch? So I think what's being asked here really is, hey, it's taking longer for insurance to reimburse us. And we're finding that we're in a little bit of a cash crunch, or we're seeing cash kind of deplete. I would say the number one thing, if I could only just share one thing, it would be double down right now on digging into your accounts receivable. You usually will find that there are opportunities for things that patients haven't paid, but if you send them a notification, they may be willing to pay. And there may be some other things that you can find, additional claims you can send to the insurance company. All of those things, if you focus just on your accounts receivable, most likely you'll be able to weather that storm really nicely and accelerate the collections a little bit. All right. So now, Austin Hare, I'm excited to have you here. For those of you that don't know Austin, you need to. He's been in and around the dental industry for quite a while. He's always been very generous to me. I think I've been on your podcast over the years. It feels like 10 times probably.
At least a handful.
Yeah, probably a handful is more accurate. But why don't you take a second, just introduce yourself to the audience here with a little bit about who you are and what you do, and then we're going to dive right into some of the challenges and things you're seeing in the dental industry.
Yeah, I love it. I have a background completely unrelated to dentistry. Started out just when I was 18 as a professional wakeboarder, learned how to house hack, and that got me into real estate. And then I started opening up some fitness locations, and then that got me more from residential into commercial real estate. And then when I sold those, I started working with my partner, and we started doing site selection for dental groups. And it's kind of a funny story. Just, I remember this was back in 2018. I was looking to do my 4th location. And so I had this idea of where I wanted to go to in my head, which I think a lot of people listening can probably relate to. And I was in Orlando. I thought to myself, hey, I got to be in Winter Park. That's the cool, sexy area. I've got to stay away from Kissimmee because those demographics are just garbage. And so I started working with my partner, and we ran a competition and demographic analysis. And what we found was that Winter Park was super saturated. It was full of competition, really high rents, and Kissimmee was wide open. And I just had no idea, because you can't make good decisions without good data. And so that was a little bit of a gut check, but it was a huge learning experience. And so I had some disagreements with the franchisor, thankfully, because I sold right before COVID. And then we got into the real estate, commercial real estate, specifically for healthcare groups, multi-site healthcare groups, dental being a large part of that. So yeah, in the background, some things about me, I still continue to do residential real estate and short-term rentals and Airbnbs. And my wife and I switched from wakeboarding to competing on American Ninja Warrior with my wife. So, we like to bite off more than we can chew always. And now we have 2 kids as well. So not a lot of free time in the Hare household. And that's my background.
Awesome. Thanks, Austin. And again, appreciate the contributions you've made over the years to the industry and to everything that we're trying to do here in the dental industry. So why don't we go ahead and jump in now? You've showed up here knowing and maybe feeling concerned about a few things and wanting to make sure that our audience is properly educated. And why don't we jump right into that?
Yeah, sure. Coming up on the end of the year in 2025. And yeah, I know you and I were just talking a second ago how it's crazy how much things change and how fast they change these days. From a real estate perspective, gosh, you look at the cycles we've had since 2008 and 2006, and it's nuts. We went just gangbusters starting from 2020 up until 2022, and then they hiked rates, and things started to really, I would say, plateau. And what the craziest part about it is that real estate moves so slow, right? It's like the Titanic, and so it just takes so long to see any of these things come to fruition. We saw really, really rapid price depreciation across the board from 2020 to 23, because even though they started hiking rates in 22, it just, like I said, it takes so much time for that to work its way through the system and for sellers to come down. So we're actually just now starting to see sellers kind of lighten up on their prices or be more flexible on their prices or give you some contingencies or seller financing, but it's very regional. It really depends on the area that you're in. Ironically, the Sun Belt got chased and driven, the prices got driven up so much because everybody was coming here. Now is seeing some of the softest markets, and then the places that were really slow, like the Northeast, they're seeing some of the tightest markets, which can command the best prices in real estate. And that's speaking mostly from a residential perspective, but it applies kind of across the board. So what does that mean? I think there's a couple of things to kind of dive into. When it comes to growing by de novos, which is kind of what we specialize in, there's a few things to consider. So I think that it's really easy to look at the price of real estate and just want to essentially pump the brakes or wait for the prices to come down or whatever it is. So the reason I would caution against that is simply because, the saying that we were talking about, the quiet dogs don't bark, meaning all of the competition that has not started is something that it's hard to wrap your mind around. So you're not paying attention to the competition that's not there. And what's happening is these high prices are actually keeping competition out from a de novo perspective. I know there's a million challenges that everybody faces, especially growing from de novo. I mean, you were just talking about the insurance reimbursement. There's always a bunch of stuff, but to sit on the sidelines, I don't think is the right answer. I think that, you should always be moving and taking steps forward regardless of the macro environment. Because if you're going to double down at a time when everybody else is backing up, then you can really start to see some outsized returns. And so on that note too, I mean, regardless of whether you're growing by purchasing your real estate or leasing your real estate, I think that there's always a benefit to being the most prominently positioned location. So, you're going to have to pay a lot right now. It's the truth. To have a new de novo or a new location, wherever you go and start up, if it's new construction, it's going to be really expensive. Even second generation space is remaining elevated. How much is that going to help you outposition your competition? And then also, is that going to mean that you can potentially lower some of your marketing costs? And so anyways, happy to dive in on some of those things. Other thing we talk about too is just the trade-offs of owning your, trying to buy the real estate versus just leasing. So happy to dive in on, any one of those three subjects.
Why don't we jump to that one first? Because I think I don't know that there is a framework that I necessarily have to work within, and probably a lot of our listeners are the same way. So could you maybe articulate what this framework would be that would help us to understand how do we make the best decision there in terms of rent or own?
Yeah. So there's not necessarily a right or wrong answer, but you do have to understand the trade-offs. And so I just remember sitting in a conference one time and somebody talking about how you should always own the real estate because, this person bought the real estate back in 1990 and they just sat on it and look how much money they have. And isn't this so great? And it's yeah, hindsight's always 20/20, but what if you'd bought Apple back in 1990? You know what I mean? You'd have a lot more money than if you just bought your real estate. And the real estate was a great investment. Don't get me wrong. It made them money, but there's always a trade-off. And that's my point. So when it comes to, do you want to own or rent your real estate? It really just comes to what is your cost of capital and what is the opportunity that you could be doing with that. So at the end of the day, if you have enough cash to buy the real estate and do acquisitions, then yeah, absolutely do both. But I see a lot of companies where it limits their growth and they have these ambitions to scale, but they don't want to grow unless they can own the real estate. And so, I mean, there's two things. Number one, it's going to slow you down for two reasons. The first one just being, there is not a lot of really good real estate for sale all the time. If you're hell-bent on buying the real estate, then you might not get a great location. So we always coach people to just focus on location first and whatever is available. So if nothing is available and that you'd like to lease, that works for you, then it makes sense to buy. But the second thing is just knowing how that's going to affect your balance sheet, right? And so a lot of banks will be reluctant to lend if you're maximizing your balance sheet. You got a lot of debt, and look, it can be great returns. I'm in real estate, that's what we do. But there's a misnomer around it being passive income. It is a business. It's a real estate business because there are things, just getting quotes from different banks alone, I'm sure people here know how long that can take. I mean, I'm working on a deal right now, a short-term rental deal, where I've talked to 12 different banks, right? And just the amount of information that they need applying, that's one small tip of the iceberg, let alone when you dive into it. I mean, if you're building a new location or developing a new location, now we're talking about zoning, we're talking about the city and the council and the easements and do you need retention ponds and the architects and the engineering and the surveys and the studies. So there is a whole scope to it. And at the end of the day, if you want to be a real estate company, in addition to being a DSO, then this can be a great move for you because you're going to have to learn that one way or the other. But if you make most of your money from your core business being operating dental clinics, then this could just be a distraction. And I think that's what a lot of people don't understand. They think they can have both. They think that they can have their cake and eat it too. So maybe you can. Maybe the real estate, I've seen DSOs who are actually real estate companies and they're growing by putting in new locations on there. So that's fine too, right? They're primarily a real estate company and they use DSOs to get more real estate. It's a different business model. I think you really have to ask yourself, like, what is it that I'm trying to accomplish? How fast am I trying to grow and scale? And is buying the real estate going to help me or slow me down? Because if it does slow you down, then it makes more sense to rent or, partner with somebody who does.
The one thing that really stands out to me there of what you were just talking about, Austin, and it is just ridiculously simple strategy. And that is do one thing and do it really, really well. Because if you start to try to do other things, you're not going to probably do them as well. And they're going to end up being things that are distracting and can pull you away from the one thing. The golden goose laying business, so to speak, is one way that I've heard it said. So I think that's really, really wise. Before we jump into anything, we just have to come back and say, what is our core business?
I think there is a framework kind of, like you mentioned framework at the beginning, and this is kind of what I've seen anecdotally, but when you're just opening up one location, usually you can get enough debt to easily buy the real estate and your practice at the same time, whatever it is. You go through what's called the dark tunnel, right? Which I know Emma Scott has talked about that a lot, and I think we've talked about that as well, but that's kind of like your 3 to 8 locations, because a lot of single operators, single general practice dentists or even specialty dentists can do up to 3 locations where they're kind of running around, filling in and actually practicing on a daily basis. But when you get past that, then it becomes like it's a totally different skill set that you did not learn in dental school. You have to learn how to scale a company and everything that comes with it. It's a limitless, unending kind of journey. So if you can get past like that 7 or 8 locations, then you've proven to the banks who want to lend, like, okay, this person can do this, which is kind of like, well, great. Well, how am I supposed to prove that I can do it if I can't get the capital to invest? So anyways, I think that you could make an argument that makes sense to kind of buy one location and then maybe you hold off on that till like you're out of that dark tunnel, 7 or 8. But even still, like, I think at that stage, if you've got some rocket fuel, like, good lenders or investors or whatever it is, like, to really step on the gas right there and grow your locations. And then when we see people get to about 70 or 80 locations, that's when you've got like enough bandwidth and you've got the ability to hire good enough talent that you can actually start your own real estate arm, and you can have a development arm or just form your own REIT or whatever it is. But I think I kind of see it in those kind of stages. So for people who are wondering, it's like, well, do I never buy the real estate? No, definitely. I'm not saying that. But when you get to a certain size, I think it makes a lot more sense than trying to do it all immediately at once.
Right. And I can see how some that are ambitious would say, well, if you're telling me I should start buying the real estate at this stage anyway, why don't I just go ahead and do it now? The reality is that the bank is going to look at you on what's called a global cash flow of your own personal household. That's ultimately, at least at first, when you're getting debt to build a dental practice, that's what happens. And you run out of that capacity pretty fast. It doesn't take too long before the bank says, okay, like we're just not going to do anything here. And then you've got to start to find other ways, other means, and build up other capabilities in order to be able to raise the money, to be able to grow. And it might mean you're merging practices together, or, there's a lot of different ways to slice this, but at the end of the day, there are just those constraints. And like you said, Austin, and like the main point is when your core business is no longer, or I should say this, when your core business is struggling because you're pulling so much money out of it to put into that pet project, whether it's real estate or anything else, that's where you need to start getting worried, and you need to start stepping back and saying, wait a minute, this is my core business. This is the golden goose. And this is how we have to roll for now. We have to be patient and take those next steps just when they make sense financially. Is that fair to say?
Yeah, 100%. I mean, I think obviously if you're trying to grow DSO, you've got some level of confidence and ambition. So it makes a lot of sense why you think that you can handle all of it, right? But we've seen firsthand a lot of people just get burned and, struggle. And I mean, you've seen it too, just DSOs as well. Like even the ones not focusing on the real estate, just the ones growing for the sake of growing, have gotten really, I don't know if you'd call it like a bankruptcy or like, they're taken over by their bank. They're outside of their covenants back when they started hiking all these rates. So, you see people get over their skis and, you just want to be careful about that 100%.
And that over the skis generally ends up looking like being overlevered. And being overlevered then puts you at risk of breaching whatever bank covenants you may have in place. And ultimately, the entire business becomes at risk. If the debt service is so overwhelming relative to your cash flow, you can't keep up with it. It could be that the bank actually comes in and takes over, or they assign a receiver to come in and take over. And that is present today. There are DSOs that are currently in receivership, and there are DSOs that are currently in default with their banks and not keeping up with covenants.
Yeah, 100%. And the other thing that I want to talk about too, that I feel like maybe there's a misconception around is just paying more for, even if you're renting, or whether you're buying or renting, but paying more for a good location. Like, I get it. Rent is extremely important. It's a fixed expense. It's never going to go down. It's only going to go up. And so getting that as cheap as possible is always a priority. Yes. But that being said, you want to do that within the confines of a good location. Because by the flip side of that, if you get a really cheap location and you're stuck and nobody ever sees you, they're never driving by, there's no brand visibility, it's going to be really difficult to move. I mean, it could cost $500 to $1 million easily to relocate all that stuff and do a new build out. So I would just say, like, success leaves clues. And there's a reason why the top 3 biggest DSOs in the world, or at least in the country, are all doing retail locations. And it's because it works. So yes, it is expensive. It is going to sting. It is more of like your, higher overhead, but ultimately that's going to pay off in the long run, because you're getting in front of those people, you're getting in front of those eyeballs. And, we see the way the market is moving, right? We see the way consumer expectations only ever increase over time. They never decrease, right? So people are not going to want to drive out of their way to go see you. As great as you are, and as good as your practice is, like, you've got to do a good job of making it as convenient as possible for the customer, for the patient. If there's anchoring next to a grocery store is an awesome strategy, right? Like, especially a lot of people are PPO, like a Whole Foods type thing, even like a Publix or some of those big grocery stores. But like, people are going there multiple times a week already. It's easy for them to just be like, okay, yeah, I'll line up my dentist appointment with my grocery shopping, right? It's a little bit, it stacks the odds in your favor just that little bit. And that's what you want to be doing as much as you can, is stacking the deck in your favor.
Yeah. And going back to the beginning of what you're just talking about there, the phrase that came to mind is, I've heard people say, if having to pay rent, I'm just throwing money away.
I would love to talk about that.
And from the basic premise here is that they feel like it's not a core part of their business and that it's something that they've got to own, where instead it's like, no, this is an expense that everybody around you, all these other dental practices are doing the same thing. Yeah. So I'd love to hear your take on that, Austin.
So the only part of your money that you're throwing away is that small little tiny piece of the mortgage every month that goes towards principal. Because your mortgage, people compare their rent to their mortgage. Like, oh, my mortgage could be the same price as my rent. Well, look, like, your taxes, your insurance, and interest, right, are not benefiting you. And because they're amortized, it's like a very small amount of principal at the beginning. And yes, that grows over time. And yes, you're missing out on the upside of the equity, like as the building increases in value. So again, it comes back to math, like we were talking about at the beginning. The question is, what is the trade-off? What is the opportunity? I mean, like, that capital, I mean, the bank is going to require a 35% down payment right now. So like, is your mortgage going to be about the same as your rent? Yeah, maybe. But like, maybe it'll be close, but like, what about that down payment, right? Like, you have to ask yourself, what kind of, and people just don't do that. I mean, it's kind of mind blowing to me, but nobody asks themselves, what kind of return could I be making with this equity? Like, am I going to make more by putting this as a down payment on my real estate? And the answer to that depends on, are you overpaying? Are you overpaying so that you can quote unquote own it? Or are you going to make more by, you could invest in another person's real estate fund, which you don't have to do anything. You could invest in the public stock markets, where again, you don't have to do anything. So I think it's just important to always be considering what's the alternative and what's the opportunity cost.
Or I want to give one more option, or feed that capital to the golden goose that is your one main thing and what is generating all of your income and has the most opportunity for the long-term growth.
Exactly. And then it's simple spreadsheet math. Okay, here's what I'm projecting on making my dental operation. Like, a lot of times the ROI, I mean, is, double digit, triple digit, I don't know. And then real estate, you're probably looking at single to double digit type returns. So yeah, like that, you just look at those two things, compare them, which is going to bring me, you're 100% right, Ken, which is going to bring me the best ROI. And look, I sound like I'm down on real estate, but I'm buying real estate. And it's not that I'm down on it necessarily. It's just that
that's
I
your
want people to
business
understand
model.
the trade-off.
That's what you do all day.
Yeah, it's what we do.
You're not funneling your money over into some other golden goose that you've got over here. Real estate and what you've been building up and developing over years. It makes sense. Like that's where you're putting your money because that's what you do day to day. So if I'm a dentist,
exactly.
what do I do day to day? I work with my hands. I'm leading a team. I'm doing those types of things. And if that's what you're doing, you've got to think about how you invest there first and optimize that opportunity first.
Yeah, 100% right. So, yeah, I think that in general, the dental industry has gotten its black eyes from just all of the same as a lot of other industries that are dealing with the Fed. But when you have so much private equity coming into the space and they're so reliant on the variable interest rates, a lot of people have gotten their teeth kicked in. And so I think that it's just been stabilizing over the past year, and I think that in general, it's still a great business to get into. I think if anything, now would be a better time to get into it than anytime in between 2022 and now. Of course, the ideal time would have been before that, right? But we can't go back in the past. So I do think that there's a lot of upside. Is that kind of what you're saying too?
Absolutely. Yep. I'm curious. I want to ask you one more question here. What do you think of the Fed increasing the rate?
Yeah, the Fed, everybody talks bad about the Fed. I do think that they're always late to the goalpost. I think that they have a lot that they have to manage. Balancing unemployment and inflation at the same time are sometimes contradictory. So look, I think they kind of did put themselves in this position. I mean, they kept rates way too low, way too long. It was insane. Like I don't know why they did that. They kept quantitative easing going on way too long, and then they cranked it up way too tight. So I think that the fact that real estate hasn't broken completely is a testament to how resilient it is. And I mean, that's what happens when you have strong fundamentals. They have essentially indicated that they're starting a rate cutting cycle. And we thought this was going to happen last September. We were hopeful, but it didn't. So what it comes down to from a real estate perspective is, I underwrite deals to whatever the current interest rate is right now. And it's got a pencil because we've learned we do not know what they're going to do. They're always behind the eight ball. I mean, that much is true. And if it makes sense with rates where they are and they cut rates, then it's just gravy. You know what I mean? When you're going through that, because then you can just refinance later. If not, then don't refinance. So I do think that we're in a rate cutting cycle. And I do think that this is ultimately going to free up a lot of the real estate, because what happened is when interest rates go from the historic lows to 7%, people think it's way too high and they're comparing everything to the 3%. Now it's been at 7% for so long. That's the new benchmark, right? That's the new high water level. So if you can get down to 5.5, that's going to feel like a steal. And that's going to unlock a lot of people buying real estate. So I do think that there's been price lock, because people, just in general, whether you're residential or whether you're commercial, you don't want to sell your 3-4% interest rate building, and then buy something a lot higher. So people just got locked in. I think it's going to unlock a lot more velocity. And I think, eventually, slowly but surely, prices are going to start to come up. So I do think it's a good time. And then in addition to that, it's always a good market if you find a good deal. To just sit on the sidelines for the sake of sitting on the sidelines is just, the market's always going to be going up or down. So we just have to make sure that we're trying to find good deals, whatever the market is, whatever fits our buy box. So that's kind of what I think about it.
That's right. Yeah, I think you can have some paralysis by analysis here, and you just end up missing opportunities, and they just keep slipping through your fingers, right? So I think that's an important thing to remember as well. Awesome. Austin, any final parting words?
I think that ultimately, I feel pretty good about just the state of the American economy and the industry in general. I think for the next few years, I can see things. Look, we're going to have a little bit of pullbacks. I don't see any recessions coming. And that's not just my opinion. I mean, I'm kind of just regurgitating the opinions of some people that I follow, right? So I've picked a couple economists and, public market analysts and traders and, real estate guys and even crypto guys. And I feel like in general, now is a good time to kind of make some long-term investments. And then even when it comes to taking on debt, if you're going to start a DSO or buy real estate or whatever, that debt is just going to be worth less today than it will be by the time that loan matures because of inflation, because of money printing. So, I would say don't be scared to get started and start to grow and start to leverage. I think yesterday was the best time to get started. Today is the second best time.
I love it. It's fantastic advice. Well, that's it for today's episode of the Dental Truth Project. Thanks again to Austin Hare for joining us and sharing all of his amazing insights. If you enjoyed the episode, be sure to follow or subscribe so you don't miss what's coming next. We drop an episode every Wednesday morning. I'm Ken Kaufman, and until next time, keep seeking the truth that helps dentistry thrive. Happy day.